Hi! Welcome to our accounting tutorials. For today, we are discussing income taxes.
The accounting standard for income taxes is PAS 12. Income tax expense, reported in the financial statements, is computed using PFRS, while income tax expense, in the income tax return, is computed using Philippine tax laws, and tax laws have different accounting treatments for some economic activities. Some items are appropriately recognized as income or expense under financial reporting, but are either a non-taxable or non-deductible and/or taxable or deductible. PAS 12 is applied by all entities in accounting for income taxes. It prescribes the accounting for current and future tax consequences of temporary differences arising from the future recovery or settlement of the carrying amount of assets or liabilities that are recognized in an entity's statement of financial position, and transactions and other events of the current period that are recognized in an entity's financial statements. And also, income taxes include all domestic and foreign taxes, which are based on taxable profits. Accounting profit and taxable profit. Accounting profit is profit or loss for a period before deducting income tax expense. Accounting profit is also computed under PFRS. Accounting profit is the total income less total expenses, excluding income tax expense. And other terms for accounting profit are pre-tax income, financial income, accounting income. Taxable profit, or tax loss, are profit or loss for a period, determined in accordance with relevant tax laws and rules. Also, total taxable income, less total tax deductible expenses. Its varying treatments create differences, called permanent differences, and temporary differences. And also, taxable profit is also called taxable income. Permanent difference arise when income and expenses enter in the computation of either accounting income or taxable income, but not both. It usually arises from non-taxable and non-deductible expenses, and those that have already been subjected to final taxes, and also, this, do not have future tax consequences. Examples of permanent differences. Temporary differences. These are differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. Taxable temporary tax difference are those differences that will result in future taxable amounts in determining taxable profit or loss of future periods when the carrying amount of the asset or liability is recovered or settled, while deductible temporary tax difference are temporary differences that will result in future deductible amount in determining taxable profit or loss of future periods when the carrying amount of the asset or liability is recovered or settled. In taxable temporary differences, the financial income or accounting profit is greater than the taxable income or taxable profit. The carrying amount of an asset is greater than its tax base. The carrying amount of a liability is less than its tax base. And the formula. Recognition of deferred tax liabilities. Its initial recognition, goodwill, an asset or liability in a transaction which is not a business combination, and at the time of the transaction, affects neither accounting profit nor taxable profit loss. Investment in subsidiaries, branches, associates, and joint ventures except to the extent that both of the following conditions are satisfied. The parent, investor, or venture is able to control the timing of the reversal of the temporary difference, and it is probable that the temporary difference will not reverse in the foreseeable future. When an investor normally is able to control the timing of the reversal of the temporary difference, if it controls the dividend policy of the investee, For an investment in associate, a deferred tax liability is normally recognized because the investor has no control over the dividend policy of the associate, unless, again, there is evidence to the contrary. Compound instruments. An issuer recognizes the liability and equity components of the compound financial instrument separately. The tax base of the liability component on initial recognition is equal to the initial carrying amount of the sum of the liability and equity components. A taxable temporary difference arises from the initial recognition of the equity component. The issuer recognizes the resulting deferred tax liability as a direct charge to the carrying amount of the equity component. Recognition of deferred tax assets. A deferred tax asset shall be recognized for all deductible temporary differences, to the extent that is probable that taxable profit will be available, against which the deductible temporary difference can be utilized. However, deferred tax asset is not recognized when the deductible temporary difference arises from the initial recognition of an asset or liability in a transaction. PAS 12 prohibits the recognition of deferred tax liability arising from the initial recognition of goodwill. Deferred tax liabilities for taxable temporary differences relating to goodwill are, however, recognized to the extent that they do not arise from the initial recognition of goodwill. PAS 12 permits the recognition of the deferred tax asset arising from the initial recognition of the goodwill, but only to the extent that it is probable that taxable profit will be available, against which the deductible temporary difference could be utilized. The carrying amount of goodwill less tax base equals to deferred tax assets. Investment in other entities. PAS 12 recognizes deferred taxes from all temporary differences, including those that are associated with investments in subsidiaries, branches and associates, and also interest in joint ventures, but except when both the conditions stated earlier are satisfied. Measurement of current tax liabilities and current tax assets. An entity uses the tax rates or tax laws that have been enacted or substantively enacted by the end of the reporting period in measuring its current tax liabilities or assets. Measurement of deferred tax liability and deferred tax asset. Deferred tax assets and liabilities shall be measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled, based on tax rates, tax laws that have been enacted or substantively enacted by the end of the reporting period. When different tax rates apply to different levels of taxable income, deferred tax assets and liabilities are measured using the average rates that are expected to apply to the taxable profit or tax loss of the periods in which the temporary differences are expected to reverse. When different tax rates apply to different levels of taxable income, deferred tax assets and liabilities are measured using the average rates that are expected to apply to the taxable profit or tax loss of the periods in which the temporary differences are expected to reverse.
Due to the change in tax rate, the usual formula of accounting profit subject to tax multiplied by tax rate equals income tax expense does not apply.
Why?
Because deferred tax expense benefit is computed based on the tax rate expected to be in effect when the related deferred tax asset or liability reverses, while current tax expense is based on the tax rate applicable in the period the taxable profit is earned. This can be done by squeezing for the income tax expense using our previous formula. Therefore, income tax expense is computed only after current tax expense and deferred tax expense benefit are computed.
Current and deferred tax arising from share-based payment transaction. An entity that receives a tax deduction for expenses that relate to remuneration paid in shares, share option, or other equity instruments of the entity should recognize deferred taxes resulting from temporary differences. Interperiod and intraperiod tax allocation. Interperiod relates to the recognition of deferred tax assets and liabilities. It is concerned with the accounting for temporary differences, while intraperiod relates to the allocation of income tax expense during the period to various items of income or other sources that brought about the tax. Income tax is allocated to the following: profit or loss from continuing operations, profit or loss from discontinued operations, other comprehensive income, and directly recognized in retained earnings. In offsetting, an entity shall offset current tax assets and current tax liabilities only if the entity has a legally enforceable right to set off the recognized amounts, and intends either to settle on a net basis, or to realize the asset and settle the liability simultaneously. An entity shall offset deferred tax assets and deferred tax liabilities only if the entity has a legally enforceable right to set off current tax assets against current tax liabilities, and the deferred tax assets and the deferred tax liabilities relate to income taxes levied by the same taxation authority.
Thank you for watching.